But even the most successful hedge fund managers can't beat the S&P over the long term, and it's been mathematically proven. You simply buy the S&P and just hold it for 30 years.
Okay. A number of different ways you can get exposure to the S&P 500, different funds that you can invest in that are really kind of designed to mirror the S&P 500 because you can't invest in it. It's an index. You can't invest directly in it. I prefer ETFs, exchange traded funds. Buy an S&P 500 ETF. Super low cost. If you just need to achieve that, 7 to 9% return over time, you want to be up about 73% of the time. You'll probably outperform 90+% of mutual funds. Then that's the way to go. He did mention something I thought was interesting. If you're not a professional watching these things every day, then don't do anything else. Just invest in the market. Now, you can get to the point in your portfolio where you can graduate into professional management, where you get treatment similar to institutional investors. They hire professional managers, institutional money managers to manage their portfolio. Why are they not just buying the S&P 500 ETF? Oh, well, maybe they believe they can do better. Now, doing better doesn't necessarily mean they're going to earn a higher return than the S&P 500. It could be a higher risk-adjusted return. You're getting more for what you're paying for. You got to think of volatility as a cost. So in other words, if you can get the same thing and pay less for it, you would always want to do that. And then you're going to have investments that are more tailored to your plan to take distributions and withdrawals from your assets. And so again, that's part of the income plan that you need to have put together before you start doing that. I'd say years before you start doing that.